I am not loving this chart yet on silver. I still think there's downside. Silver could come back to $45. I don't, by the way, think gold's going to zoom right to 5,600 again.
Some investors will hear that and celebrate. Others will immediately roll their eyes, as you know. But build that bridge for us. I mean, how does gold get from around $4,000 to $13,000?
Now, you guys know that overall, I've been bearish on gold, but I'm now at a point, once we got below 4,000, where there's a little bit of downside potential. On silver, I need to see us recapture this $65 to $64 level and break out above this trend line, much like I need to see gold break out before I can get heavily bullish on this. You might say, well, can gold break out without silver? And the answer is it can kind of move up on the back of Kevin Warsh's statement and the Federal Reserve statement, where we can see these type of whippiness. But where do things settle? Where does the dust settle? And that gives us the signal there. And we want to look to see, is the jobs market as strong as people think it is? And if it starts to weaken a little bit, the dollar will fall very quickly. And that's one more positive for the gold price.
Let's begin with gold. It traded down to roughly $39.95 this morning, and it has now broken above that $4,100 in the same session. I mean, sitting here kind of floating on that level. So, does that $100 reversal kind of confirm that the buyers have taken control, or does gold need to kind of close above 4,100 before this becomes a genuine technical breakout?
Yeah, and that's really what the charts are telling us. So, great move on gold, but look at how this what we call a wedge pattern in technical analysis has behaved. You take your all-time high, it hits again here and here all the way down. And recently, we've been hugging just below this major trend line. And this trend line for me is essentially the line that I'm watching to know when there's a breakout in gold. And notice how today we rallied up into that line, and so far gold has pulled back off of it. And so as a technician, simply put, just like you said, 4,100, we need to clear that hurdle on a daily closing basis. If that happens, you have a short-term breakout. I don't, by the way, think gold's going to zoom right to 5,600 again. It's going to take some time. It's going to take some digestion, but that's the first step in potentially seeing gold start to recover and move back to its all-time highs.
Yeah, so a little close, maybe above 4,100, tells you that this, was more than just a temporary reaction to this.
Markets rallied, but the level that actually matters still hasn't surrendered. Gareth Soloway notes that a daily close above 4,100, not an intraday spike, is what separates emotional buying from institutional conviction. Retail investors often celebrate reversals, while larger funds wait for confirmation before increasing exposure. That difference in discipline can determine whether portfolios compound or chase another false breakout. Next, Gareth Soloway reveals why one overlooked confirmation signal could invalidate today's excitement entirely.
That's what I think. Again, we have to respect the trend line that has held up since the highs on gold until price really clears that hurdle and holds above it. I'm looking at it a little skeptical. Now, you guys know that overall I've been bearish on gold, but I'm now at a point, and once we got below 4,000, where there's a little bit of downside potential, but we're close to the end of this down cycle before I do think the price on gold starts to move up. And it's got some upside potential over the next few years.
Yeah. I was watching. I know you put out some new targets too. We'll get to those. The first move following a Federal Reserve's decision is not always the move that lasts. What follow through do you kind of need tomorrow and then into the end of the next week before you believe this rally has real buyers behind it?
Yeah, and so the first thing we want to see is that close above 4,100. Once we get that, you don't want to see the next day it come right back below 4,100. And so there's something called the confirmation signal, where you get a close above a key level, and then you need to see a secondary close above that level and a little bit higher than the previous day's high. What that tells me is there's real teeth to the move. It wasn't just a whipsaw like you're talking about here, where we're seeing this kind of move up on the back of Kevin Warsh's statement and the Federal Reserve statement, where we can see these type of whippiness, but where do things settle?
The first reaction after a Fed decision is often the one professionals fade. According to Gareth Soloway, confirmation requires multiple closes above resistance because institutional capital rarely commits after a single headline-driven surge. Markets frequently reward patience while punishing investors who mistake volatility for trend changes. Waiting for follow-through may feel boring, but preserving capital usually is. Next, Gareth Soloway exposes why the dollar's next move could matter more than today's gold rally.
Where does the dust settle? And that gives us the signal there. And really, the other thing, too, is the dollar's been hovering here. And if we go to the charts, let me show you guys this. This is interesting. So the dollar has been hovering right up in this upper zone. And we could see, again, going back a ways, even back over here in 2025, we came up to this high and it got rejected. And here we are. We came up, rejected, and here we are again getting rejected. You want to see the dollar continue to fall here. If the dollar continues to back off resistance, now we're in a state of potential upside in gold. Lastly, just watch this trend line here. If we pull back to just under 100 on the DXY, and if we break that, gold's got significant upside in the near term and midterm.
Yeah, I was going to say, I mean, if Wars keeps a September rate hike kind of alive and the dollar holds this range, I mean, can gold kind of continue rising with that sustained dollar strength that you've seen?
You know, it's going to be tough for gold, right?
Yeah.
And part of it, too, is that oil is a major component here. Oil is pushing up the 10-year yield because it's raising inflation expectations. And so we've seen recently this run up on oil back into the $80+ range. You want to see oil come in. That will relax the potential of these rate hikes. We also want to see what the jobs data is coming up for this past month here as we're coming to the end of the month.
The dollar keeps failing at resistance while headlines insist its strength remains unquestioned. What Gareth Soloway is highlighting is that gold's path may depend less on gold itself than on whether the dollar finally loses momentum below key technical levels. Media attention stays fixed on Fed speeches, while currency behavior quietly tells a different story. Next, Gareth Soloway unravels why employment data could overturn the market's confidence in the dollar.
And we want to look to see, is the jobs market as strong as people think it is? And if it starts to weaken a little bit, the dollar will fall very quickly. And that's one more positive for the gold price.
Hey, quickly on this, I mean, I want to move on to your gold call, but I'm curious. I mean, could today's move have been kind of accelerated by traders who were positioned maybe for a surprise increase and suddenly had to cover?
I do think so. I think that the sentiment on gold has gotten to almost equal bearishness versus how bullish it was when we were trading north of 5,000. I mean, I used to do videos and people would attack me for saying gold was going to pull back. And now vice versa, I'm seeing when I do a video on gold and I talk about the cycle here and the bigger cycle that we're in, how we're going to eventually break out and make new all-time highs, people are telling me gold's going back to 1,800. And so it's the inverse of what we saw at the highs, which actually then creates that bullish catalyst for the offsides trade to kind of push gold back higher.
You know, I was watching your latest video, and it's kind of, we need to talk about that number that jumps off the page. I mean, your latest long-term work kind of maps a potential peak in gold around $13,000, but between 2029 and 2031. Now, some investors will hear that and celebrate. Others will immediately roll their eyes, as you know. But build that bridge for us. I mean, how does gold get from around $4,000 to $13,000?
Extreme optimism and extreme pessimism usually appear near major turning points, not in the middle of trends. Gareth Soloway's argument suggests that today's deeply divided sentiment could become fuel for a longer recovery if weak holders continue exiting first. Investors protecting purchasing power should watch positioning shifts instead of emotional forecasts. Next, Gareth Soloway reveals the framework behind his controversial $13,000 long-term gold projection.
Yeah, so it's based on a calculator that I created, and essentially the calculator takes into effect multiple factors. One is how fast is the money supply, and again, we're not talking U.S. money supply, global money supply running, and right now it's running at 7%. So if you just assume over the next 5 years at 7.5% or greater, that starts to push the cycle of gold. And what we looked at here is when you have the first cycle between 1980, the second peak was 2011. So we're talking, 31 years there of interim cycle. And then the next cycle, it was just 2011 to this 2026 high. And so what we're seeing is because of the increased U.S. deficit and global debt, the increased money supply, real rates, and inflation, all of these are creating shorter cycles in gold and then more dramatic moves to the upside. And essentially, it's a calculator that calculates the probabilities of the next move. And again, it's telling me that 13,000 is going to be the next peak, but again, between 2029 and 2031. Now, like you said, people are going to hear that and say, oh, I don't want to wait that long. But keep in mind, that doesn't mean we're not going to make new all-time highs before that. It just means the next cycle peak, the
Yeah.
one that, we dream about, that may just take a few years to come by. And it's really at shortest about 3 years out.
Okay. So, I mean, you got that calculator you're talking about. What's doing most of the work in the model? I mean,
Global money supply expanding around 7% annually matters far more than most daily price headlines. This is where Gareth Soloway's thesis shifts from chart reading towards structural monetary trends that institutions quietly monitor for long-term allocation decisions. Whether his exact target proves correct matters less than recognizing accelerating currency expansion. Next, Gareth Soloway exposes which variables carry the greatest weight inside his forecasting model.
is it kind of that technical cycle that you were just chatting about? Is it government debt, central bank buying, falling confidence in government bonds, or does gold need all of those forces moving together, you think?
The calculator accounts for all of those cycles, right? Or all of those factors, and it gives different weightings to the importance of it. Part of this cycle calculator as well is analyzing the fiat feeling. And then what I mean by that is, how do people look at fiat? And if you looked at in 1980, we had incredible inflation, but at the same time, we saw Volcker come out and he really reestablished that we're going to clamp down on this. And over the course of that next 20, 30, 40 years, we've seen the fiat feeling. In other words, how do people feel about the dollar and other currencies? And we know they're printing them and the governments are running up debt. It's starting to slide. And so these factors all go into the model, and it really just projects out based on the past cycles and how quickly it's coming. When will the next cycle be, and what is the likely peak, taking into account these other variables?
I wonder, Gareth, I mean, if gold reaches $13,000, has gold become dramatically more valuable here, or has the dollar simply become worth dramatically less?
Yeah, and I think it's more about the structural need for people to have security, and it's the fact that the dollar needs to be measured. And this is interesting, right? If you look at the dollar, the DXY, we're basically at levels we were years ago. And so if you look at the dollar by itself, you say, well, the dollar really hasn't lost any value.
The dollar can appear stable while quietly losing purchasing power beneath the surface. Gareth Soloway notes that confidence in fiat currency is itself becoming a measurable economic variable, not merely a political opinion. That subtle shift explains why institutional diversification into hard assets can continue even without a collapsing DXY. Next, Gareth Soloway reveals why comparing currencies against each other may hide the real inflation story.
That's not true. And the reason it's not true is because you're pricing it against all the other currencies, the 5 other currencies, and they're all printing too. And so really it's a matter of saying, okay, well, yes, the dollar is still holding its strength, but that's relative to these other currencies that have been printed ad nauseum with the dollar. You have to look at it on a universal basis against the growth in supply. I believe gold is growing about 1.7% per year in supply versus the printing of money, the debt increase, all of these other factors. And that's one of the reasons why this model shows that there is such significant upside in gold, because there's no chance, in my opinion, there's no chance we can go back to Volcker, right? Yeah. I mean, could you imagine with the U.S. debt where it is, if interest rates even went up to 10%? And so when you have that in effect, it means that Volcker can't come back, which means you're not going to get a downside move like we saw in the 1980s in gold. And in other words, it's going to drive gold higher quite substantially.
And on the other side, I mean, we're always in for surprises in the market, as you know well, my friend. So, I mean, what would kind of make you reconsider the $13,000 target? Give me, the price or kind of a development that would tell you that the model's no longer behaving as you expected.
Yeah, and so for instance, if we saw, let's say, AI create deflation,
Right.
if we saw the productivity going up substantially, but again, that deflation being created by AI, that would be something that we'd have to take into account.
The dollar looks resilient only because nearly every major currency is being diluted alongside it. According to Gareth Soloway, comparing fiat currencies against one another can hide the broader erosion in purchasing power driven by expanding debt and money creation. Long-term investors should measure wealth against scarce assets, not relative currency strength. Next, Gareth Soloway exposes the one development that could genuinely challenge his bullish long-term outlook.
What's interesting is with the model, it actually gives us a significant ability here to kind of project that out. And I want to, if you don't mind, I want to try sharing this with you guys. If we get to this, and here's the gold calculator, what we can see here is that we have our different inputs. You have debt issuance pace, and this is right here our current conditions. So right now, every year the U.S. is printing basically $2 trillion. All right, and the idea is that that's probably going to go up based on the kind of the cycle that we've seen with it increasing over time. Then we have global money supply rising at 7% a year. We have the fiat mistrust index, which continues to inch up little by little. And then we have real interest rates. And so the idea is that what I did is I said, okay, this is my base case. And if we flip to the base case, it shows that on average over the next 5 years, we're likely going to be printing or adding additional debt per year of 2.8 trillion. And that's the average over the next 5 years. Global money supply is going to likely increase to 9%. The fiat mistrust analysis is going to accelerate, and then real interest rates is going to be drifting to zero. In other words, the Fed is likely going to eventually cut rates, but inflation is not going to go down substantially.
Few investors realize that assumptions about debt growth can reshape long-term asset values more than quarterly earnings reports. What Gareth Soloway is highlighting is a framework built around persistent fiscal expansion rather than short-term market sentiment. If debt issuance and money supply keep accelerating together, preserving purchasing power becomes increasingly difficult through cash alone. Next, Gareth Soloway reveals how changing a single assumption dramatically alters the model's outcome.
And so when you calculate that all out, it gives us a target range right here with a $13,000 peak. And again, what's beautiful about this is you just brought up, like, what if real interest rates are positive? Well, now all of a sudden, this changes the calculation to $6,000. And so people can really, and again, I can give you guys the link so people can actually just play around with this. You can put in your own numbers. Like maybe you think the debt issuance pace will jump massively to 4.7 trillion. In any case, the point is the calculations tell me, based on my best assessment of the data and probability, that we're looking at that next peak around 13,000.
Interesting. Yeah, I got to ask you, I mean, when gold moved below $4,000 this morning, I mean, were you interested in buying immediately, or did you kind of need to see the recovery before treating it as an opportunity?
Yeah, so for me, I still have to watch this chart because I'm not convinced. And listen, to be fair, I have gold holdings that are long term, like physical metal holdings, and so I'm not in a rush to buy more. The level where I will start accumulating more gold is at around 3,500 to 3,700. So we're almost there. We get one more little flush down, I would accumulate more long term. Now, on a swing trade basis, when we look at the chart is always my guide on a swing trade basis.
One assumption change cuts the projected gold target nearly in half, exposing how sensitive long-term forecasts really are. Gareth Soloway's argument suggests disciplined investors should stress test every scenario instead of anchoring to optimistic price targets. Institutions constantly revise probabilities as new data arrives, while retail often clings to a single narrative. Next, Gareth Soloway exposes the price zone where patient accumulation becomes more attractive than chasing rallies.
So looking at the chart, as soon as we take out this high pivot here, go to the charts here, this right here, once we get above this, that's where I would buy as a swing trade basis. But again, for my long-term holdings, I just buy physical and I wait until I get it to a level where I feel comfortable. You know, I never want to sell my physical. If my physical silver and gold is my insurance policy, where if I don't need it, if catastrophe doesn't happen, I pass it on to my kids. It's just that that's the way I view my long-term physical holdings. If I want to buy and sell, I'm doing it on a swing trade basis with the GLD or other metrics or other ETFs.
Well, let's talk about that, because you did recently, I think you taken a position in the gold mining sector through GDX, right? I mean, why own the miners now? Is this a short-term kind of technical trade, or do you believe that the miners are finally positioned to outperform gold itself?
So for right now, it's the same sort of situation. I don't really have a position in the miners at this point, but we do have a bull flag building. But just like the GLD or the gold chart, I'm looking to see, do we break out? I do think that ultimately you will see the miners outperform gold. So for those of us out there that want that better return, now it comes with added risk. As we know, miners tend to go down a lot more than gold physical as well.
Owning physical metal and trading mining stocks are two completely different strategies, yet many investors blur the distinction. This is where Gareth Soloway's thesis shifts from wealth preservation toward tactical risk management based on technical confirmation. Institutions separate insurance assets from speculative positions for a reason that retail frequently overlooks. Next, Gareth Soloway unravels why silver's sharp rally may be sending a very different signal than gold's.
But again, that would be a way to play at the GDX. And I do like certain miners as well. Newmont mining, I mean, best of breed is always what's attracting me, especially ones that pay a dividend.
I was going to ask you about that, but you already answered it for us. Okay, well, let's move on. I mean, silver rarely does anything quietly, as you know. Today was no exception. It moved roughly $56 and 64 cents to more than 59. I think it's back around 58. Anyway, that's a gain of more than 3%. So, I mean, does silver's stronger move confirm what gold is doing, or is silver simply exaggerating that short-term action as it often does?
Yeah, I think for the most part, it's exaggerating it just because silver tends to move in multiples of gold, or at least 2x gold. I am not loving this chart yet on silver. I still think there's downside. You could see, again, you had this beautiful base right here where we just kept on hammering on it as support, and then finally we broke lower. And then notice how this trend line was support, but once you break down, it becomes resistance. And we went up into it, and price got rejected, and now we're just kind of floating sideways. There's no real good nature to this. So on silver, I need to see us recapture this $65 to $64 level and break out above this trend line, much like I need to see gold break out before I can get heavily bullish on this. And I actually still think there's a good chance we touch $50 and retrace to the 2011 peak before silver really has its next major run.
Silver's biggest rallies often attract buyers precisely when technical damage remains unresolved. Gareth Soloway notes that reclaiming former support is more important than celebrating percentage gains after volatile sessions. Momentum without structural confirmation has trapped investors repeatedly across previous commodity cycles. Next, Gareth Soloway reveals why industrial demand could temporarily hold silver back even if gold keeps advancing.
That's interesting. Okay, so it'll test that zone, and they could expect that test and maybe a nice little bounce after that.
Yeah, that's what I'm thinking right now. And so I wouldn't be surprised if silver still has more downside. Now, you might say, well, can gold break out without silver? And the answer is it can. It's generally unlikely, but it could break out slightly. And the key why silver could be an underperformer is imagine all of a sudden we get a slowdown in CapEx for data centers. We know that a lot of silver and copper is being used there. Or if the global or domestic economy slows down, that industrial side of silver could mean that silver does underperform in the near term if we get that economic slowdown.
Hey, I mean, if you're at home and your time horizon's kind of 3 years, let's say, I mean, which would you rather kind of own at today's price? Do you think it's gold, silver, or the miners?
I would choose gold for the longer term. And I say that mainly just because it's safer, right? If you're thinking about someone who has a longer term horizon that doesn't want to be scared out of a trade. I mean, for all we know, silver could come back to $45 or $40 per ounce. I think the gold trade is the one because it's the one that's most directly tied to what we know, which is the U.S. debt is at 40 trillion almost. We have that kind of the printing of the global fiat continuing to rise at least 7% a year. And so you're playing directly the play that the governments and central banks are going to never really be able to rein that in because global debt is just so high, right? So we just can't go back to that Volcker style, which means long story short, you get more money printing. So I think gold's the safe kind of play. Is it going to be the sexiest? Is it going to go the most? It may not, but at least you sleep better at night.
The safest investment is not always the fastest performer when economic conditions begin changing. According to Gareth Soloway, gold remains the steadier choice because its long-term drivers depend more on debt expansion than industrial demand cycles. That distinction becomes critical if global growth slows while governments continue creating new currency.